And coming up on the program, the International Monetary Fund expects sub-Saharan African economy to shrink by 1.6%, even as debt levels are expected to sharply increase in 2020. Global airline losses climbed to $312 billion due to coronavirus pandemic. And Kenya's parliament approves value-added tax cut in virus relief. Thank you for joining us and welcome to Business Incorporated. I'm Chimezie Obi. We begin with the intraday market numbers, and here in Africa, the South African JSE index was down 2.99% after the country's economy was projected to shrink by over 5% in 2020. However, here in Nigeria, the reverse was the case as the Nigerian index was upbeat despite the bleak economic outlook. The all-share index was up 1.52%. Egypt was in the red as well, down 1.07%, while Kenya opened the trading week on Tuesday up 1.92%. And most Gulf indices slipped at intraday due to a warning that the global economic downturn could be at its worst since the Great Depression of the 1930s, underlining the economic damage already done by COVID-19. Saudi Arabia's benchmark index fell 0.89%, hurt by a 1.2% drop in oil giant Saudi Aramco. The Qatari index was down as well, 0.87%. In the United Arab Emirates, where vital sectors such as tourism and transport are at a near halt, stocks retreated a day after rising. Dubai's main share index dropped 2.21%, with its largest lender, Emirate MBD Bank, shedding 1.4%. In Abu Dhabi, the index declined 1.23%, led by a 1.8% drop in First Abu Dhabi Bank. Meanwhile, the UAE said on Tuesday it was extending the period for excise tax payments due from businesses for 1 month. And in Europe, markets traded lower in the morning despite the region starting to lift restrictive measures in various countries to allow the economies to gradually restart. Let's talk to Annette Wisberg, my colleague there in Frankfurt, to tell us more. Hello, Annette. Good afternoon. Good to see you again.
Hey.
All right, European shares dipped after a great run last week and, of course, yesterday. Why is that, and what's the focus for investors?
Well, actually, you see it behind me at the big billboard that really shares are headed south. And the reason behind that is that people are now concentrating on the earnings season, which kickstarted now in the United States. And you see, especially with the banks, but also with other corporates, that the general lockdown of major economies like here in Europe, but also partly in the United States, does have severe effects on profitability. If you look at equity valuations, that what people have said since the recent rally, they went back to historic average levels, which is actually fairly priced. And given the uncertainty, we don't know whether there will be a second round of infections. We don't know what really how corporates will evolve from that crisis. Many investors do say that equities are quite expensive currently at that pricing level. And what we are seeing is now a reversal of that rally, which has lasted quite long during last week and also yesterday.
All right, now China's central bank is again easing to support the economy. What have they done, and what are the prospects for the Chinese economy?
Well, actually, China has, or the Chinese central bank has eased or has cut another central rate once again, and also has reduced the amount banks have to hold as reserves. So essentially, the measures combined do mean that they have injected some $43 billion to the economy. And there's a reason for that, because on Friday, China will publish their GDP data for the first quarter. And most likely, GDP has contracted by 6.5%. And that would be actually the first quarterly contraction of Chinese GDP since 30 years, to give you an idea of how grave, how serious the situation is also for the Chinese economy. And with recent information coming out from the state of how they are doing with the coronavirus, we also see that the moment they take away most of their lockdown lockdown measures, the virus is spreading once again. So it's also not very clear whether China will actually have a big revival in the second quarter with the Chinese economy opening at full swing. So there are loads of dark clouds over the sort of economic horizon also for China. And we'll also watch very closely other economic activity indicators with what China will publish also on Friday. So overall, the Chinese authorities do what they can to actually bolster the economy. Whether it's enough remains to be seen.
And still across the Atlantic, U.S. airlines are to receive about $25 billion rescue package. Is it enough? And how do the markets react? Is more needed for the sector looking overall?
The markets really liked the package. Airline shares did rally in response late yesterday when the U.S. market was still open. So it is a major relief because clearly with air traffic literally coming to a standstill also in the United States, passenger volume dropped by some 95%, aircraft activity not as much, but almost as much by some 85% because cargo, of course, does play a role currently with the delivery of medical goods, etc., pp. But still, airlines are in a very severe situation, and American airlines anyway don't do overly well in general. So what the government has done now is to put $25 billion to the airlines to safeguard just jobs until the end of September. Those airlines who are going to tap the money are not allowed to lay off people. So there's a guarantee or a job guarantee for airline staff until the end of September. And on top of that comes a pot with $25 billion in loans, which of course the airlines would have to repay, but still it gives them also more liquidity to get over that very difficult stretch of time when they literally don't have any business. So essentially that package will safeguard airlines, American airlines, until the end of September. And the underlying assumption is then afterwards activity actually should pick up by October at the latest. So if we are not going to see that, this will not be enough. If we are going to see a benign scenario in which perhaps business travel also is going to pick up perhaps during the summer or perhaps September, then that should be enough. But we don't know as of now, but what we know is that bridges the period in which American airlines could actually file for Chapter 11 once again until the end of September.
Well, we'll wait and see what happens eventually. Thank you very much, Annette, and enjoy the rest of the day.
Thank you.
And in the UK, government is expected to publish an exit strategy from the coronavirus lockdown this week. Let's get the details and, of course, the intraday numbers from my colleague there, Juliana. Good afternoon, Juliana. Well, Labour is asking the government to publish an exit strategy from the coronavirus lockdown this week. What do they want to hear precisely?
Well, Chimeze, what they want to hear is how Britain is going to get itself out of this economic mess. We've had some pretty grim figures this week, not just from the IMF, which predicted that British GDP could fall by as much as 6.5%, but the government's own lobby group, the Office for Budget Responsibility, they also predicted that if these lockdown measures continue, then in Q2 this current quarter, Britain's GDP could plunge by as much as 35%. And that's really shaken a lot of people up, particularly the Labour Party, the opposition party. They've just appointed a new leader, Sir Keir Starmer, and he's been delivering a series of interviews around the media, just asking for accountability. Over the weekend, he was actually saying that he wants Parliament to start resitting again so there can be a credible opposition asking the government what exactly is going on. Of course, we've all seen around the world that it's much easier to get into into a lockdown than it is to get out of it. And there are fears that there could be some economic consequences that Britain will never be able to escape from. We are expecting tomorrow stand-in PM Dominic Raab to deliver the government's analysis on how long this lockdown will last. Nobody expects it to be lifted tomorrow, of course, and we're expecting it to last for a minimum of a further 3 weeks. And Keir Starmer, the opposition leader, did say that he does stand by that, and he thinks it's a good choice, but he does want to see an exit strategy. And we are hearing that there could perhaps be some divisions within the government. So we've got Chancellor Rishi Sunak and the Home Secretary Priti Patel on one side of the fence trying to fight for the economy, and on the other side we've got the Health Secretary Matt Hancock and Michael Gove that are more interested in saving lives. But again, you know, there are a lot of observers, a lot of people saying at the moment it shouldn't be a choice between saving lives and the economy. It shouldn't be either or, and that's one of the issues that the government is facing.
And extra support to help businesses through the coronavirus lockdown has been announced by Scottish ministers. What are the details of this support?
Well, the details are pretty scarce. They've just been released, but it really comes because a lot of Scottish businesses, particularly the SMEs, are not happy with the support that they've received from the government. Of course, the Scottish government and the infrastructure is pretty much devolved from England. But when the Chancellor did announce those bailout measures in March, about £2 billion of that was allocated to Scotland. So there have been a series of funds and grants that have been allocated to small businesses, but they've been complaining that it's just not enough. And as we've seen across the nation, it isn't trickling down fast enough. There was a petition that was put in place and the government have now responded. So they have put a further £220 million into trying to help businesses, particularly small businesses who have been asking for the same treatment that they've been seeing and witnessing in Wales, England and Northern Ireland.
All right, it's intraday, of course, brings us up to speed with the market numbers and, of course, their drivers.
Well, the FTSE opened in the red this morning, and at intraday, it seems as if those losses have widened. The all-share is down by 2.32%. The FTSE 100 is down by 2.21%, and the FTSE 250 is down by a whopping 3.70%. Also, a bad day for currencies. The pound is down on the dollar by 0.90%, down on the euro by 0.46%, and down on the Japanese yen by 0.75%. Some of the major drivers really are what's happening with dividends. A lot of companies, major FTSE 100 companies, are still cancelling their dividends, which we've seen for the past couple of months. There's been a little bit of a sell-off with some of those companies, which has pushed down the FTSE 100. And also as well, even after that historic deal, which was signed over the weekend with OPEC and their partners, oil is still plummeting. BP and Royal Dutch Shell at intraday are down by 5%, Jimmy.
All right, thank you very much, Juliana. Enjoy the rest of the day. And stocks in Asia were little changed on Wednesday as the economic impact of the coronavirus pandemic continued to weigh on investors' sentiment. Mainland Chinese stocks dipped on the day with the Shanghai Composite 0.57% lower. The Shenzhen Composite shed 0.53%. Hong Kong's Hang shed 0.8%. In Japan, the Nikkei 225 closed 0.45%. The Topix ended slightly higher at 1,434 points. Shares in Australia finished their trading day in negative territory. And stock futures were lower in early morning trade following a big rally in the previous session fueled by optimism that the coronavirus outbreak is improving in the U.S. Dow futures fell, indicating a loss of about 80 points at the open. The S&P 500 and Nasdaq were also slated to open in the red. And the International Monetary Fund has projected that sub-Saharan Africa will shrink by 1.6% this year, just as it sees a recovery for the continent in 2021. The fund made its projections clear in a webinar at the ongoing virtual spring meeting today, hinging the drivers on border closure and plummeting global demands. According to the IMF Director of Africa Department, Mr. Abebe Selesi, the sub-Saharan Africa contraction is expected to be the worst since 1970. No country will be spared from the economic slowdown. Mr. Selesi warns that Nigeria will be one of the worst hit countries, but asks its leaders to devote more resources toward public health management, infrastructure and education in order to manage the unattended risks. In the meantime, the global economy is expected to shrink by 3% in 2020 in a stunning coronavirus-driven collapse of activity that will mark the steepest downturn since the Great Depression of the 1930s. The International Monetary Fund, in its global economic outlook, also expects global debt to increase significantly over the next year. And when we come back after the break, we'll look at what Kenya is doing to mitigate COVID-19 effects on citizens. Do stay with us.